You get a royal charter, not a business license, a charter that lets you raise your own army, build your own navy, mint your own coins, and wage actual war. A monopoly on trade routes worth more than most kingdoms' treasuries. Ships come home loaded with spices, silk, porcelain. Shareholders get rich. You run a piece of the world like your own private country. Simple enough. Here's the problem. That picture leaves out almost everything that actually happened. A trading company with its own army and its own tax collectors wasn't just doing business, it was occupying, extracting, ruling. And the people paying for that monopoly, with their land, their labor, sometimes their lives, were never shareholders. This isn't the story of a clever business model. It's the story of what that business model actually cost and who it costed to. Here's the part nobody tells you. The biggest cost of owning a colonial trading company wasn't the ships, wasn't the spice monopolies, wasn't even the wars with rival empires. The biggest cost was this. A company built to trade goods eventually had to become a government. And once you're running a government, you're paying government-sized bills forever, profit or not.
Before ships, before spices, you need to understand one thing. A trading company on its own, ships, warehouses, cargo sitting in a harbor, was worth almost nothing. What made it valuable was a single piece of paper, the charter. Not a business license, a state-issued grant of sovereignty. The charter let a private company wage war, build forts, mint its own coins, and hold the monopoly no competitor could legally touch. Take that paper away, and you just had some boats. But the charter did something even bigger than granting monopoly power. It solved a problem that had killed every trading venture before it. Under old law, any single investor could demand their money back at any time and force the whole operation to liquidate. Nobody could build anything permanent under those rules. The charter changed that. It locked investor capital inside the company for good, and in exchange let investors buy and sell shares to each other instead of pulling their money out. Quietly, that's the invention of the modern stock market. For the first time in history, a company could raise money from the public, lock it in for decades, and use it to build permanent fleets, permanent forts, permanent armies.
This is the first thing to understand. The company wasn't really in the spice business. It was in the business of turning a legal document into a permanent, self-funding, quasi-sovereign machine. Everything that machine touched afterward, the trade, the wars, the colonies, was downstream of that one piece of paper. So what did it actually take to get one of these companies off the ground? The charter alone didn't do anything. You still had to raise the money. Take the Dutch East India Company, known by its Dutch initials VOC, founded in 1602. It launched with 6,440,200 guilders raised from the Dutch public. Anyone in the Republic could buy in, roughly 265 million euros in today's money. And that wasn't a loan. That was permanent, locked-in capital the company never had to give back. Now compare that to the Dutch West India Company, chartered less than 20 years later in 1621. Built on paper to look almost identical, same regional chamber structure, same governing board. By 1623, it had raised just 2.8 million florins, less than half of what the VOC pulled in. Why? Investors weren't buying a spice monopoly this time. They were buying a war with Spain and Portugal in the Atlantic, and the public wanted no part of that risk. The Dutch state, the cities, and the VOC itself had to prop the company up just to get it running.
Then look at the French West India Company, chartered in 1664 under Louis XIV's finance minister. Of its starting capital, the king personally put in 2 million French livres. Private investors, the people who were supposed to be funding this thing, contributed only 1.3 million. The crown had to promise to cover every operating loss for the first 4 years just to get anyone else to sign on. 3 companies, 3 charters, 3 monopolies on paper.
One raised a fortune from the public in months. The other two had to be propped up by kings just to open for business. The difference wasn't the paperwork. It was whether ordinary investors actually believed they'd see their money again.
Now, here's where the numbers get interesting. Remember the VOC's original starting capital? 6.4 million guilders, raised from the public back in 1602? That was supposed to be the big number. That was supposed to be the whole operation. By 1766, the VOC's annual military budget alone had climbed to 12.2 million guilders. 1 year. Read that again. The yearly cost of just defending the company's monopoly, the forts, the private army, the navy patrolling the trade routes, was nearly double the entire startup capital the company had raised a century and a half earlier. And this wasn't a one-time bill. This was every single year for as long as the company wanted to keep the monopoly it had built its entire business on. You didn't just buy a trade route with that charter. You bought a standing military commitment that would eventually cost you more per year than the company had been worth on the day it was founded. Once the charter was signed and the first fleet came home successful, the expenses didn't stop. They multiplied. A monopoly this large didn't run itself. It needed a government.
The VOC's governing board, the Heeren 17, had 17 directors split across 6 regional chambers: Amsterdam, Middelburg, Rotterdam, Delft, Hoorn, and Enkhuizen, each with its own delegates, its own agenda, its own slice of the vote. Amsterdam alone appointed 8 of the 17 seats. On paper, no single chamber could dominate. In practice, Amsterdam's money bought it control anyway. Underneath that board sat an entire specialized committee, the Haags Besond, whose only job was drafting policy and correspondence for the company's outpost in Batavia, 9 months away by ship, one way. The English East India Company had it worse. Its court of directors was made up of bankers, ship owners, merchants, retired company men, and lawyers. 7 different occupational backgrounds sitting around the same table, each representing a different private interest. Directors who owned ships voted to pay their own shipping consortia inflated freight rates to carry the company's cargo. The company didn't build its own fleet the way the VOC did. It rented ships from private owners. Every voyage was a negotiation between the company's interest and a director's personal side business.
Now add the trade problem. Underneath all of that, Europe had almost nothing Asia wanted. No market for European wool or ironware in India or China, which meant every spice, every bolt of silk, every crate of porcelain had to be paid for in silver and gold, draining precious metal out of Europe with nothing flowing back except cargo. The VOC's answer? Build an entire second trading network inside Asia just to generate cash without shipping bullion from home. Spices for Indian textiles, textiles for pepper, pepper for Japanese silver, that silver used to buy the next round of spices. An entire shadow economy built just to avoid draining the mother country dry. And when a monopoly resisted, the company didn't negotiate. In 1621, the Banda Islands were the only place on Earth nutmeg and mace grew. The Bandanese wouldn't sell exclusively to the VOC at the company's price. So the VOC's Governor-General sent 19 ships and over 1,600 soldiers to settle the matter permanently. More than 90% of the Bandanese population was killed or enslaved. The company carved the islands into plantations and staffed them with enslaved labor for the next 200 years. Because a monopoly on a spice that only grows in one place isn't really a trade agreement. It's a hostage situation, and somebody has to enforce it.
So, with costs like that, how did any of these companies stay solvent for 200 years? Because underneath the spice trade, there was a second, quieter business model, and it's the one that eventually swallowed the first one whole. In 1717, the Mughal emperor granted the English East India Company a decree that changed everything. The company could trade throughout Bengal completely duty-free. No customs, no tolls,
for a fixed annual payment of just 3,000 rupees. Every local merchant and every rival European trader paid taxes at every border crossing. The EIC paid almost nothing. On top of that, company officials could issue transit passes exempting cargo from inspection entirely. Passes employees routinely abused to smuggle their own private trade past local tax collectors for free. That was the entry point. The real transformation came after two battles, Plassey in 1757 and Buxar in 1764, when the company went from trading with Bengal to ruling it. In 1765, the defeated Mughal emperor formally handed the EIC the Diwani, the legal right to collect land tax across Bengal, Bihar, and Orissa. And this is the part that matters. Before 1765, the company had to ship silver from Britain just to buy Indian textiles and silk. After 1765, it used tax revenue collected from the Indian population to buy the very goods it was exporting to Europe. The company stopped paying for its own trade. Its colonized subjects paid for it instead.
To squeeze that tax revenue reliably, the company restructured the entire system of land ownership. In Bengal, local tax collectors were turned into permanent landowners overnight, on the condition they handed over 10/11ths of everything they collected and kept only 1/11th for themselves. Miss a payment, and the land was seized and auctioned. In Madras and Bombay, the company skipped the middlemen entirely and taxed individual farmers directly, based not on what they actually harvested that year, but on what the land was theoretically capable of producing, sometimes over half of it, rain or no rain. On top of taxation, the company kept every smaller revenue stream running too: tolls, duties, monopoly fees on goods moving through its ports. None of these alone was the empire's fortune, but stacked on top of a captured tax base covering 3 provinces, they turned a trading company into something closer to a government that also happened to sell tea. Here's the honest answer. As a business, money in versus money out, evaluated on paper the way any accountant would evaluate it, these companies were often walking wounded for decades before they actually died.
The tax system the EIC built to fund itself worked exactly as designed, right up until it didn't. The Ryotwari and Zamindari systems both demanded fixed cash payments regardless of harvest, so when the monsoon failed in Bengal in 1770, the tax bill didn't fail with it. The company kept collecting. The result was the Great Bengal Famine, roughly a third of Bengal's entire population dead, while the company that was supposed to be governing the province kept extracting revenue from the survivors. The VOC's ending looked different, but it followed the same shape. By 1780, on paper, the company still looked enormous. 28 million guilders sitting in the Dutch Republic, 46 million more in Asia, 62 million net of debt. Then the Fourth Anglo-Dutch War broke out. British ships cut the VOC's fleet in half, seized its cargo, and severed the 9-month sailing route between Europe and Asia completely. No return fleets meant no auctions. No auctions meant no cash to pay off the short-term loans the company had been rolling over for years just to keep paying its shareholders their usual dividend. War damages alone came to 43 million guilders. Emergency loans to stay afloat wiped the company's net assets down to zero. The board was dismissed in 1796. The charter expired on the last day of 1799. The Dutch state absorbed the debts and the territory, and 2 centuries of corporate empire quietly became a government colony. Both companies died from the same disease, just at different speeds. A monopoly propped up by force costs money whether or not the trade is actually profitable that year. And the year the trade finally stopped covering the bill, there was nothing left to fall back on but debt. As a commercial enterprise, evaluated purely on what went in versus what came out, the Colonial Trading Company was, for long stretches of its life, a terrible investment. The military costs were relentless. The administrative burden only grew. And the very tax systems built to rescue the balance sheet ended up starving the people who were supposed to be funding it until there was nothing left to extract.
These companies were never really trading companies at all, not for long. The charter, the monopoly, the private army, the tax collection, all of it was a government wearing the paperwork of a business. And a government funded by shareholder dividends instead of public accountability was never going to hold together forever. The VOC didn't collapse because it stopped being good at trade. It collapsed because it spent a century and a half proving that a joint stock company simply cannot run a country the way a country needs to be run, not without either the country or the company eventually breaking under the weight of the other. The trading companies that lasted longest weren't the ones with the biggest monopoly or the widest territory. They were the ones that understood, even briefly, that a charter is a leash, not a crown. And the moment you forget which one you're holding, someone else collects the debt. And if you want to keep pulling threads like this one, the ledgers behind history's biggest myths, subscribe, because we're not done opening the books.